Okay, now we see more people joining in. So let's not wait and then start the session today. And then we'll at the same time see if there's more people to come in. So welcome and thank you for spending after work nighttime with us, 1 hour with us to learn more about private investment. I think most of you might want to know more about the financial markets for your own interest or just for more learning. So we hope that the session today will be helpful for you. Okay. So before we start, we have two speakers today, me and Pacey. So we'll have a brief introductions of ourselves. I'm Angel. I'm a client advisor at StashAway Hong Kong. So in StashAway, we have human advisors to give independent investment advice to our clients, and I focus on working with our clients to know about their financial goals and their life planning. So to introduce and plan for their investment to meet their goals. And over to you, Pacey.
Everyone, again, thank you for joining our webinar today. My name is Pacey. My role in StashAway is similar to Angel. I also offer wealth management advisory services for our clients. And in this series, we talk about how to invest with ETF through asset allocation. And this last part is private investments. And I'll say today it has never been easier like today in investing in the private market. So I think some of the private market investment is very essential in everyone's diversified portfolio. So back to you, Angel.
Thank you, Pacey. Yeah. So as StashAway, just like Pacey just said, we right now in the industry in the market out there, private investment is made more accessible for most of us. And then StashAway, we are a digital wealth management platform that provides personalized and curated investment solutions from cash management to ETF based diversified portfolio and to private investment that is much accessible compared to the traditional channels that you might know. And then we made it simple and cost efficient and very intelligent as well. So as you can see the screenshots here, we have an app. So very easy. If you download the app from the App Store, you can start navigating and then look at different portfolios that is tailored to your risk level or your goals. And then there's so many informations there, and then different goals. There are different portfolios that can meet to your different goals. So just now we have the academy. A StashAway Academy series talking about how to invest with ETF, asset allocation, and finally we come to the private investment portfolio, which is also available on our app. So StashAway, we started 9 years ago. So we now have operations in 5 markets. So Hong Kong is one of them. Right now, we manage over billions of US dollar asset under management and with trust of many, many active customers in our investment solutions. We are backed by a few famous VCs like Sequoia, Square, Pack, and also, very importantly, the customers' assets are held by our custodian banks. So just to make you sure that the fund invested here is safe and is segregated from our company operating money. So, StashAway, we aim to be a personal financial secretary for everyone. So, just very simple at your fingertips. You can start investing with a 10-minute onboarding, and then you can start with any amounts. There's no lockup, no minimum, of course, no maximum as well. And then we use algorithm to design investment solutions that is tailored to your own risk and most importantly, is very cost efficient. Our management fee is as low as 0.2%, so it's substantially lower than the traditional channels like brokers or a bank that you know. Okay, so let's start with the main contents today. So our goal today is to understand these few things. First, we'll introduce the basic of private market investments to you, and then after knowing that what is the difference between private market and public market, why should we invest in it? And then after that, if we decided to choose private market to be a part of our entire portfolio, what is the concern? What are the risks or possible returns that we can consider when we choose a private market investment? And finally, if you're interested, how to be eligible to access the private market and grow your wealth, and then to enrich your entire portfolio. Okay, so just like Pacey said, private investment is made more accessible for everyone, even for retail investors. So in this trend, you can see from the very beginning to recent years, the AUM, the under management in the private market industry has grown significantly, thanks to the technology and then also a rise of fintech like us. So the private market investment is made easy, and everyone that so everyone can consider making a private market investment in the part of the portfolio. Okay, so as we know that there are different asset classes from the previous webinar, right? So there are equities and there are bonds and real assets. So right now we all well known that there's like stocks, bonds, or REITs that is publicly tradable in the market. But there are also corresponding assets in the private market as well. So there are respectively private equity, private credit, private REITs or infrastructure that can serve the similar purpose, but with a different characteristics. So first, start with private equity. So private equity is usually just imagine like this: you are the investor of a company, but these companies are not traded on the market, but they are in fact some private companies. So let's list some example. For example, OpenAI. This is a very hot topic and rising star recently. So this is actually a private company. So the people or the pension funds or the corporate investor that invest in this companies, they hold a share of the private equity of these kind of companies. And the exits are usually secondary asset acquisition that you sold to another strategic investor or financial investor, or finally they go to IPO so that the shares are made publicly available that can be traded in the markets. So these are the examples: venture capitals, growth equity, and buyout. So venture capital you see is more aggressive side, and for buyout is more of the less aggressive side in the private equity world. So StashAway, we are actually also a private company, and we have so just now we introduced StashAway, right? We are backed by a few famous VCs like Sequoia Capital. So these company or these PE funds, they invested in the shares of StashAway. So we would say that we are also a part of like growth equity. So this is an overview of private equity fund market structure. So it's very easy to understand. So investors, they are usually called the limited partners. So investor is the one who pull out money in their pockets, and then they employ a general partner, usually a private equity firm, that they will source out different private equity or private company to put in the portfolio, and they act of the interest of the investors to generate return, and then to select different investments. So here you see quite a sophisticated formula, but let me break down it into simpler terms. So how PE fund creates value is basically we want to make a company better so that we can benefit from the overall return that is from the company growth. So here the EBITDA. So it's basically the earnings from the company. So through some operational improvement, some influence into the management or the private company, they will have better overall returns, overall um, 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 how to say the revenue and the bottom line. So so they will have a better cash flow in here, and then after after we know that okay, this company is improving, so maybe the market will have a greater valuation to this company, and at last the leveraging. So maybe in the start of the company, we want to expand the business, so sometimes we'll use that we'll use borrow money to acquire more staff or put on into marketing. So with these three factors, we will have the overall value creation or improvements for a PE fund. So you see here, like into the recent stack case, the major driver is from the operational improvements. So the operational improvement is largely a effort from the general partners. They work with the company owners to improve their business, and you see in the very beginning, the major driver is from the leveraging, because at that time the rates environment is really high. So even if they even though they take down a bit of leveraging, there will be a lot of value creation back then. So the J curve for PE. So if you invest in an early company, just take an analogy of raising a child or growing crops. So at the beginning, you will need to plant the seeds and then wait for the return or wait for the plant to grow. And after a few years, you will have your harvest period, and usually it's like 7 to 10 years, then you can see some positive cash flow in your PE funds. But these are the structures of the traditional PE funds usually. But right now, in the recent year, we have a lot more of semi-liquid PE funds that you don't need to wait for 7 or 10 years to finally see the return. So later on, we will introduce more about these type of semi-liquid PE funds. And then moving on to private credit. So private credit is very simple. So basically, we as individuals, we will, for example, borrow money from bank. For example, we buy a house, we take mortgages. So private credit is also a lending, but is between companies that is not lending, is not borrowing from the bank. So good thing about credit is that they are having a higher seniority in the capital structures. That means that if a company finally touch wood, they collapse, the debtors can get their money before the equity shareholders will receive. So this is the structure of a private credit fund. So similar to PE funds, the investor pull out money and then they employ a general partner to source different deals in the private credit world to put in the private credit fund. So the two typical type of lending is non-sponsor lending and sponsor lending. So sponsor lending is usually like some is applied into leverage buyout because those companies who need the lending is actually backed by a private equity fund, which is you should imagine that you are in team with a very strong partner. And usually for non-sponsor lending, it's more like a direct lending. So usually it will need more, it will be more aggressive compared to sponsor lending. And private credit has taken the market shares from banks recently. The reason is that if you work with bank previously, you will know that the loan process usually take really, really long, and private companies working with private credit managers, they because they have a long-term relationships, and the private credit managers are usually more flexible to tailor to different terms to the deal or the lending provided to the companies. And yeah, and also the confidentiality or sensitive information is usually kept secret. So these are the reasons. Okay, so private credits, there are different tranches. So the most common one is usually the senior secured debts, which is very common in the PC fund. So they are the highest seniority in the tranches. So let's say if the company so these debtors will be get paid at an earlier stage, but usually because it's lower risk, so the target return will be lower. And going down here, you see a more aggressive or more higher risk type of private credit will be like distressed assets. So take an example would be the China mortgage back in a few years. So you see the return is really, really good, but it's also associated with a high risk. So finally, go into private infrastructure. So let's see. So this man, and I think a lot of Hong Kong people know this man very well. Li Ka-shing is one of the richest tycoon in Hong Kong. And earlier in a few months ago, there's a big news that CK Hutchison is selling global ports to some private funds. So this aroused some kind of talk of town at that time. So actually, private infrastructure is just imagine like infrastructure here in our daily life. We see different infrastructures, for example, like tunnels or airports. So some of the infrastructure is publicly owned. For private infrastructure, is usually owned by a privately owned by some companies or by some investors. For so for private infrastructures, there are different themes. For example, the most common one would be the or those we can see day to day will be the supply chain and logistics, for example, rails, airports that we just mentioned. And recently, we have more rising or more people gain more interest into different themes like digitalizations, the data centers. For example, right now the AI is on the boom, so the data centers, the demand for data centers are on the rise. So there are different themes, and different themes will give you different returns. And so the these private infrastructure, on one side they will give you say cash flow, um, that is generated from the leases or so on. And at the same time, because the demand or the valuation of these private infrastructure will be on the rise. So another part of return is from the improve of their valuations of these type of infrastructures. So this is the cycle of how an infrastructure, a private infrastructure, creates value. So at the very beginning, the investor will or the GP will acquire a mature infrastructure that will give you a steady operational cash flow. So how do they determine if they should acquire this infrastructure? Is usually like at a discount or at a building new constructions. And this type of infrastructures, they will generate like steady cash flow. For example, let's say take an example of a tunnel. Every time a car pass by a tunnel, they need to pay a toll, right? So this is the operational cash flow from that infrastructure. And then through after they acquired the infrastructure, just like it's just similar to PE. It's like the GP will influence and then improve the operation of that infrastructure. So, for example, they will grow the number of signed contracts and the contracts quality, or to upgrade or expand the infrastructure. And on one side, they will improve the operation efficiency to to have lower costs, and at the same time, they will improve the revenue, and maybe sometimes they will use leverage to improve the overall operational efficiency of the infrastructure. And finally, if the operation of that infrastructure is improving, then at the end they will exit. So usually it's sold to different types of investors, usually strategic investors like government, corporates, and to financial investor, which is maybe other asset manager or wealth managers. Yeah, so this is a summary of the private investment profiles. For private credit, it will be more focusing on the passive income. So the target returns is usually like 5 to 15%, depending on the strategy. Compared to PE or PI, private credit is usually lower risk because as we just said that they are in the higher seniority of the capital structure, they get paid earlier. Compared to the shareholders. And the expected duration of the investment will usually be shorter, like 3 to 5 years. And compared to PE and PI, they are usually higher risk, but of course, they will give you a higher return over the long term. The expected returns is usually 10 to 25%, depending on different strategies or different vintages. And for private infrastructures, they sometimes will come with a dividend, but it's not guaranteed. So the most of the return is expected from the improve on the valuation. So to see the improve of the valuation, usually it takes longer. So if you invest in PE or PI, you should expect like 7 to 10 years of the investment horizon. But just now I said there are more of like semi-liquid funds here. So there are no more like J curves right now. So you can so with semi-liquid funds, the expected duration of the investment horizon usually is lower, is shorter. And the fees is a bit different as well. So for PE, sometimes they will have the management fees and performance fee after the return is passed over some benchmark. And for private credit, it's usually a flat fee. Okay, so now we will introduce why we will invest in a private market, and I will hand over the time to Pacey.
Sure. Thanks, Angel. So let's go to the next slide. So here, these are the core differences between the traditional market, like the public market, and the private market. So let's look into it into details. In terms of liquidity, the public market is higher. And in terms of valuation, the public market is very efficient. It prices intraday, actually every seconds, every moment, and is highly available to every individual general investor. So people might think, then why should I still consider investing in the private market? It has low liquidity. The valuation is usually either monthly or quarterly, and it's limited to only a small group of people. So why do I still need to invest in that? I think if on this page, one of the very important reason is diversification. If you look into the correlation to the different markets, private markets in general has low correlation to the public market, and that's one of the main reasons why people are considering adding it into their overall diversified portfolio. And if we look into the next slide, we can see that historically, institutional investors they have much higher allocation into the private market. Well, according to if you see on this chart for any endowment funds in general, they have high allocation to the private markets and also followed by the sovereign wealth fund. And for traditionally, for any private investors investing in the private market, it's only restricted to the ultra high net worth individuals or only a small part of the high net worth individuals. And so, which means in general, people have very low allocation or under allocated in the private market. So in the previous session, I also talked about why you should invest like an institution. And from your individual perspective, usually people have these three goals of why they should invest in the private market. You want an enhanced return, a return that like assuming that you already have a diversified public market portfolio that you want something that can boost it a bit. You want lower volatility because private market investments, they are not marked to market. So compared to the public market, they have much lower volatility. And with the evergreen fund now available, they can better balance the volatility versus liquidity premium. And lastly, it offers broader diversification, not just because it has low correlation to the traditional asset classes, but also more companies are staying private at the moment. So it enlarge your investment universe. So we will talk about that in the following slides. Okay, so StashAway, we are a data-driven investment company. So everything that we talk about, we check the data. And here is the 10-year asset class performance across the different like asset classes like equity, credit, and infrastructure. And what we can see here is that we all know in the past 10, 20 years, S&P 500 index or the US equities is one of the best performing markets in the world. However, if we compare private equity versus the S&P, private equity's average return annually is even higher in the past 10 years. And if we compare private equity versus MSCI, meaning that versus the world economy, is delivering at least a 4% higher of return. So this is the case for equity. How about for credit? Credit also outperformed, despite that the maybe the outperformance is slightly smaller compared to its public market benchmark. And also private infrastructure, same. One of the very important thing to notice in private infrastructure is that some people think they can invest in infrastructure through investing in REIT, the real estate trust listed in the different exchanges. However, there is still fundamental difference between investing in private infrastructure and those REIT. Here, we can see that private infrastructure outperform. Why? because private infrastructure, unlike those public REIT, is not subject to the daily trading fluctuation of the public market. So it's much less volatile. And in the same time, the underlying investment of private infrastructure, many of them are directly investing in the assets versus in a REIT, in the public REIT, sometimes you're investing in just the company, the operating company of the certain infrastructure. So a direct investment in the real assets make a difference. Okay, we go to the next. Yes, so just now we see that private market in the past 10 years outperformed the public market. And what about in the bad times? Is the risk really high or are they resilient? According to this chart, we look into the data. Maybe we should update it to 2025, but here it's up to 2020. If we look into the data at this moment, so for private equity, you also need to differentiate between a buyout equity or a VC or growth. So in a bad market, VC actually, well, indeed, they have a high risk. Their risk is higher than the public market. But if it's private equity that is the buyout type, even in the worst 5 year, its analyzed return is still positive compared to the bad performance of other markets. And credit even stronger actually in the bad economic environment. Private credit will still deliver a positive return because the default rate, the enhanced due diligence of the borrowers, so the default rate is lower. And in terms of real assets, unfortunately, everything's down. But private infrastructure, compared to many other real assets, such as the public REIT or real estate, for example, the drop of it is lower. It's only at 2%. So this is something we bear in mind in terms of risk at the bad times for private investment. Moving forward, here I just want to show you the correlation between the different asset classes. If we look at the bottom 4 lines of the different private assets, you can see that the correlation with the public assets in general is lower than 0.5% of correlation. So that meaning that it can effectively add to the diversification of your assets. And like I said, many of the companies are staying private at the moment. In fact, not every company wants to go public because going public, although you have the potential of raising more money from the market, you also are subject to a lot of scrutiny of regulatory reporting and lots of costs in terms of going public and filing the different reports. So in North America, 87% of the company with like for any company with a revenue larger than 100 million, 87% of them are now private. Versus in even the case for Europe and similar in Asia. So by investing in private companies, you are actually uncovering some of the potential gems in the market. And those gems, although they might not as big as those big techs or mega cap market cap companies, but they do have a strong revenue profile and profitability profile, especially for those buyout type of private equity investment. So after talking about like the basics of private markets and why you should investing in it, how should an individual investor analyze it? Here we want to provide with you an analysis framework. So we do not just talk about all the good things about private market. Private market has an inherent risk when you invest in them. We have mentioned they have lower liquidity. They have the underlying investment usually have limited information compared to the public market equivalents. So meaning that the manager selection is really key. So if you the underwriting capability of the fund manager is not good and you chose a wrong manager to invest your private investment, it really does create a lot of difference in terms of your return. So first, let's talk about how we should address the liquidity problem. Historically, for private markets, usually they are those closed-end funds with multi-year of commitment, 7 to 10 years or even more. So this part restricted a lot of individual investors to invest in it. However, ever since actually, I think it's like before COVID or after COVID, lots of those evergreen solutions appear in the market. What does evergreen mean? Evergreen means that your money invested in the fund, unlike traditional one that you need to wait for a capital call to deploy your investment, to wait for a harvesting period. Evergreen fund, once your money is invested, is fully deployed. The experience will be just like you investing in a mutual fund that I believe many of you have the experience of investing in that. And you might think, isn't it normal that I put my money to a manager and then my money should be fully function and fully deployed at once I give them the money? The case is in the private investment world, it's not that easy because you need to have a very robust deal flow to really have some strong deals, many strong deals actually, for the managers to be able to deploy the money at a fast speed. So this that also relate to why manager selection in the private market actually matter. Moving to the next slide. So for customers, for investors, when you invest in a private funds, it's very difficult for you to get the full information of the specific fund. However, there are many platforms that they do the due diligence when they onboard different private market funds and onboard different partners. And these are the full aspects that for any fund manager due diligence that we usually suggest people to do. So for any fund, the very important thing is that these are the 4 Ps that you need to look into: the people who manages the fund, the investment philosophy of the fund, the process, the governance of the fund, and also finally the performance. So we should never just look into a performance of a specific fund to make our investment decision because it's risky, it's not mark to market, and fundamentally, these other 3 Ps also matter. So in terms of the due diligence, we can do investment due diligence and also operational due diligence. Investment due diligence, usually we check those policies and standards and the investment strategy consistencies of the specific fund. And for operational due diligence, that's also important because we don't want the fund to be rely on a talented fund manager or rely on the talented founder to get the deal sourcings. We want it to be an institutional structural process to for the deal sourcing, for the value creation, and also for exit. Moving on. And what are the key performance metrics that you should pay attention to when investing in private markets? So this part, as an investor, you should be able to get the information because all the different funds they are required to disclose these metrics to the investors. And for private equity, the most common metrics that people will look into are the IRR, multiples of invested capital, MOIC, and also DPI, distributed pay-in capital. So why you need to see it? So for IRR is that you want to see how fast you see a return. So a higher IRR usually means that the money or the performance, the return is getting back to you faster. The higher it is, meaning that they use a shorter time to give you back the higher return. So the higher, the better, the IRR. And multiples on invested capital is best to when you have the question of how much money did I make in total. So because why you also need to look at MOIC besides IRR is because sometimes some fund managers, not saying many, they can manipulate the IRR a bit. How to do so? They can. It's not, or I should say, it's not manipulation. It's that through financing, right? They can borrow the bridge loan first and then call the capital later so that the IRR will become higher. It's just a mathematics calculation. But to see how much your money that you actually make in total, multiples on your invested capital is maybe it's a better metrics. And DPI is also important. You want to see that how frequent, how fast the money is distributed back to you. You don't want to wait for 10 years for it to pay the money back to you. For a traditional closed-end fund, ideal way is that you can see it in year 5 or year 6 of your investment. But if you invest in an evergreen fund, it's not an issue anymore, and perhaps only the monthly return matters because you can redeem monthly as well for evergreen fund. And for private credit, it's different. You perhaps besides because it's yield driven, but perhaps besides tracking the yield of the credit, you should understand the credit seniority in the capital structure, what kind of credit that you are investing in. Because a very important metric in the credit world is the default rate. So that you need to understand the credit quality that you are invested in and default rate matter. One benchmark that I can give you is that if you invest in investment grade bonds in the public markets, it's around historically on average, the default rate is around 0.1%, very low. So for private credit, you should also bear that in mind. And how much additional yield I am earning above the public market equivalent? This is to assess whether you're taking excessive risk by investing in the private credit. And usually for the same risk level, private credit delivers 200 to 400 basis point more compared to its public market equivalents. This is usually a liquidity premium. And lastly, to assess the risk of private credit, you can also consider the loan to value ratio of that private equity fund, per credit fund, to make sure the yield that it generated for you is not highly boosted by the leverage. It's really from the quality of the underlying credit deal. Okay. Because of the time constraint, we did not deliver the key metrics of private infrastructure, but for private infrastructure, it will be very similar to the equity investing plus some specific. If we got time in the future, we can also talk more about that. And lastly, let's talk about how to assess the private market. Like what I said in the beginning, assessing the private markets has never been easier. We go to the next slide. So the case in Hong Kong is that you need to become a professional investor with a minimum of Hong Kong dollar 8 millions of financial liquid assets to be qualified as a professional investor. Of course, the minimum investment amount can be much smaller. But please note that 8 million Hong Kong dollar of liquid asset excludes the property. And also when you should consider starting adding the private investment is that you already have a diversified liquid portfolio. If you tell me that today let's say your 100% of total wealth, maybe 60% or 70% is actually in the property that you invested in property, then I'll consider perhaps you still need to build a diversified portfolio, liquid financial portfolio before you enter the private market because you already have a concentrated risk in one type of alternative asset, which is property. And in the past, if you want to invest in private markets, the private bank usually requires you to have a ticket size for a single fund for minimum 250K US, or even 500K US. Now it's much lower with different digital platforms. And plus, if you become a StashAway Reserve customer, not only that you can access the different private investments across asset classes, but also you don't need to worry whether you're all on your own because there is personalized wealth advisory services provided to you. Once we verify the professional investor status, there will be a dedicated advisor to contact you and will explain you all the details about the private market investments. So, StashAway, we have a full suite of products to meet your needs. Currently, in the private market, we offer across private credit, private equity, and private infrastructure. In Singapore, we actually also have venture capital and angel investing if you're someone with a higher risk appetite. But for the market now, we think that the trend is to offer evergreen private market solutions for the client and is suitable for most of the high net worth individual client who is the first timer in the private market investment. In summary, now many digital platforms, including StashAway, we offer institutional grade investment. So even though you invest the minimum with us, your asset class, your share class is just the same as other institutional investor who might invest 2, 3, 5 million to that specific fund. And the access is very simple. All you need to do is just to verify the professional investor status. And similar to our other investments, the fund is under the trustees' segregated account. So and plus, it's also we partner with large private equity managers to do the fund investment, so it's safe and secure. This comes to the main content of the webinar today, and you can feel free to use the StashAway Academy promotion to enjoy 3 months of investing with your StashAway account. And we also provide a free consultation session for you, so feel free to scan the QR code for a session of personalized advice. And now we open the floor to questions. If you have questions, you can type the question in the Q&A box in Zoom, and then we'll answer that. We'll stay online for the Q&A session, but if you're urgent, feel free to have other things that might want to have dinner. Of course, we understand. Then feel free to drop the line. So for the time I'm waiting for the question, maybe let me ask a question to Angel first. So Angel, what are the most common questions that you see in when a client is a first time private market investors? What usually are the questions that they ask?
Wow. Of course, like when our investor is new to private markets, of course they have a lot of different concerns and different things that they consider. I think of course, like first of all, they look at the returns, but before we look at the returns, let's take a step back to look at the bigger picture. So usually for each of you, you actually might have different goals or different preferences, right? So just now we mentioned that there are private credit, private equity, private infrastructures. So instead of looking at just returns, what is your goal? Are you focusing more on the on the passive income, or are you looking at a diversification into maybe you hold a very concentrated public stock portfolios. So yeah, I think the most common question would be, what should I choose? So there is
Okay.
no conflict in each
Yeah,
of this. Yeah.
I agree.
So
I agree.
yeah.
Yes.
So
Yeah. So yeah, I think the goal-based approach applies across public and private markets. And so when you bear what to choose is actually not the ultimate question. The ultimate question is what exactly your goals are. Okay, I see one question in here and more coming. Okay, this question is are the managers of the private deals also picked using your algorithm? So I guess it's meaning that how do we select a manager? For private investment, it's actually how we select the manager is not by algorithm. Well, if the data allows that we also want to do our algorithm in private investment, however, the one of the key the feature of private investment is that there is not sufficient data. Unlike public market that you can have different economic indicators that each ETF or each stock they have loads of tons of data generated every day, and then you can analyze the news as well. Private markets for the deals, in very often before they actually invested in it, it's private. So a lot of the negotiation, the terms are not available to for the algorithm to analyze. So for private market manager selection, we still use the approach of doing the due diligence of the manager and also negotiate a stronger term with the manager for our investors. So short answer is not pick with the algorithm at the moment.
yeah, so to add on to that, so for algorithm picked or formed portfolio, which would be these portfolios we have. So let me talk a bit about general investing. So this is the flagship global diversified portfolios that we have in StashAway. So these are, so just now we said StashAway is we form our investment solutions largely data driven, and then we have our own algorithm. So for general investing here, we want to provide diversified portfolios for every one of you. So here comes two things. So first thing is that we have different risk level that is quantified into percentage. So for general investing, we have something called SRI, which is Statutory Risk Index. The percentage is the maximum drawdown that you might have when the portfolio is experiencing a market correction, just like the financial crisis or whatever. So these general investings and thematic portfolios, it is actually managed by StashAway, or we also have BlackRock as our partner to manage the algorithm as well. So these are the parts, the public investment portfolios that we use our algorithm to generate to pick and to have different allocations into different sectors and different regions to form this portfolio for you.
Okay. So I checked the Q&A box. There is no there is there are some questions, but we can answer those questions offline. We will follow up with you one by one. I think so we will also after this session we will also send out follow-up, and for those who want to revisit the content because we know that it's a lot, so we will also send out the video recording to those who are interested in revisit the content. Sorry. There is actually one more question for it. Follow up to the question, actually the same audience. What makes StashAway private deals more appealing than those offered by other financial institutions? I'll say that in short answer is exactly the three key pillars that we show as institutional grade. Like other financial institutions, I think we got some of the best share classes compared to other financial institutions. The second is that the lower minimum and great fee. I would say I won't say the lowest fee, but it's a very low fee for our investors. So with the same type of institutional class asset that you can get into it with a lower fee and much lower minimum, then we think it's very beneficial to our clients. And lastly, in StashAway, that our approach in advisory is it's like a consultant. So we remember your StashAway advisor is not compensated by commission. The fee-based model determines the nature of our company. So we will only recommend suitable investment to you. Today's session is about private investment, but we also always remind investors when consider adding private investments into your portfolio, you should always see whether there is a concentration. And in general, despite the high return of private investing, we usually suggest that investors should not invest more than 10% or 15% of their total net worth into the private market, just for the sake of risk management. Thank you. Okay, I guess it's coming to the end of this webinar today. Thank you so much for joining the webinar, and we will see you in other StashAway event. And remember, actually, one of the early releases that in November we will have an event together with one of our partners in private market investment. So stay tuned for the email invitation to be sent. Thank you. See you.